Good morning, everybody. How y'all doing today? It's funny because I actually had another thing that I wanted to talk about today. Like another thing I wanted to share, which I'll probably do tomorrow. But funny enough, things happen for a reason. So I was having a conversation with a buddy of mine, and it sparked a realization in my mind. Sometimes when you've been doing a thing as long as I have, sometimes what happens is, a lot of what becomes like second nature. It becomes what you feel is basic common knowledge, right? And you forget a lot of the times that what is not common knowledge. It is not, something that everybody just knows, right? And so sometimes you make the mistake of overlooking things or not spending enough time on a topic because you think people know already. So it's like, you're beating a dead horse. And I realize that that's not the case. And so because of that, even though I touched on this topic briefly before, I want to spend a little bit more time on it because I think that is really, really important. So in light of that, this is a hashtag Get Real Woke discussion on shedding light on business depreciation. And I think that when I break this down, I think that you'll begin to understand why it is that the wealthy stay wealthy. What it is that they understand, that the average business person, let me say the average small business person just doesn't really understand. And we're going to talk about a couple of things when we get into depreciation. So first of all, what is depreciation, right? What is business depreciation? So business depreciation is the ability to take an asset and basically subtract the value from what you bought it for compared to what it's currently worth. The difference is called depreciation. So let's say that, and I'll keep it nice and simple. Let's say you bought a cell phone. Let's say you spent $1,500 on this cell phone. You bought it in January of 2021. By the end of the year, let's say that cell phone only has a value of $500. Well, the difference between $1,500 and $500 is what we call depreciation. That's what we call depreciation. So at that point, right, what happens is when you subtract that $1,000 out, you can actually, that depreciation, that loss in valuation, you can actually use to offset your capital gains from a tax standpoint. So that is what depreciation is. Now, let's look at some of the ways that you can use depreciation in a business. And I think it is very important to understand this as a small business. So let's take that same cell phone. Okay, you buy a cell phone. You spend $1,500 on that cell phone. Well, your business buys the cell phone. So the business buys the cell phone. The business spends $1,500 for this cell phone. Great. That is write-off. You can write off that full expense. The beauty of it is that you get what I'll call a 2-for-1 bonus, right? Not only can you write off the cost of the cell phone, you can also write off the loss in value. So again, $1,500, let's say it's worth $500 at the end of the year. You write off the $1,500 as a direct expense. You write off the $1,000, right, of depreciation as a depreciable expense. And now you got a 2-for-1 bonus. The cool thing about depreciation, and I think that this is very important. Here's the very cool thing about depreciation. The very, very cool thing about depreciation is the fact that depreciation lowers your tax liability without affecting your cash flow position. What does that mean? So when you bought the $1,500 cell phone, that was a direct expense because the company actually had to spend the $1,500. So the company actually, the company's cash flow position changes by $1,500 because it had to pay the money to buy the cell phone bill. To buy the cell phone. However, when it comes to the depreciation, that's just a loss in the value or worth of the cell phone based on the time you've had it. And because of that, that extra $1,000 of write-off doesn't change the company's cash flow position. It's not like the company spent an additional $1,000. No, that didn't happen. What happened was the value of the asset changed. The asset lost value. And because of that loss of valuation, that loss of the difference between what you bought it for and what it's now worth, you can use that to lower the tax liability without affecting the cash flow position of the company. And that's a very cool thing. And I think that, as small businesses, a lot of small business owners miss a lot of depreciation opportunity. For example, you buy a laptop. The company buys a laptop. That laptop is used for business purposes because, of course, you need a laptop to be able to do spreadsheets, maybe build a website, maybe write letters for the business, send emails. There's a lot of things that you need a laptop for. This laptop is a business expense. So let's say you spend $1,000 for the laptop. You get to write off that direct cost, that direct expense. And, of course, when you bought the laptop on day one, it's not going to be worth the same thing it was worth by the end of the year. You're not going to get the same $1,000 for that laptop if you bought it in January by the time December rolls around. It's just not possible. And because of that, you now have a depreciation on the value of that asset. And now you are able to use that to write off and depreciate your tax liability. That's that 2-for-1 bonus. Now, let me tell you a cool thing. So, I incorporated my name, Fredrick D. Scott, LLC. Fredrick D. Scott is actually a limited liability company, right? I incorporated that back in 2013. Why would I do that, right? Let me teach you a really cool thing. Now, as you guys know, I do a lot of lives. I put out a lot of information. I myself personally am a brand, completely and separate from the other business endeavors I have. When somebody books an assessment with me, they're not paying Fredrick D. Scott, the person. They're paying the business, Fredrick D. Scott, LLC, which has its own tax ID number and everything. Now, here's the cool thing, right? And I recommend this for anybody who is a content creator, an influencer, anything that is considered a public figure or someone that is in the face of the public on a regular basis. I definitely recommend incorporating your name for sure in a tax ID number. And let me tell you why. So here's the cool thing. Remember, I'm a brand, right? I'm a brand. So what that means is, right, when I go out, if I do an interview, if I'm meeting with a customer, a prospective customer, anything of that nature, because I am in the public eye on a regular basis, right, my image is important. The way I look is important, right? So, for example, if Fredrick D. Scott LLC decided that it wanted to go out, right, and buy me an entire new wardrobe, suits, business casual clothing, etc., for the purpose of matching my image, right? And developing my image better. All those clothes are business expenses, and I can now write them off. Because I am a brand, because I am in the public eye, because my image and the way I come across and project myself is so important to the success of the brand. So now I get to write off clothing. Now, does that mean I get to write off sweats and t-shirts and things like that? That's a bit of a stretch. That's a bit of a stretch because, like you see, I wear sweats pretty regularly. You know, that's a personal thing. I probably wouldn't want to write that off. But if I'm putting on a suit, or if I'm putting on a business casual situation, likely that's going to be for the purpose of business. And so because of that, and because I'm a brand, I get to write that off because the business now can purchase these items for me to be able to continue to operate and successfully grow the company and grow the brand value. That is important. And if you think a shirt has the same value that it had when you first bought it at the beginning of the year, by the time the end of the year rolls around, you're wrong. So guess what? That shirt can now be a depreciable asset as well. It depreciates too. Most assets depreciate. I mean, all assets depreciate. And depreciation is so important. Now, the IRS does have rules on depreciation for specific types of assets. And, you know, when you start getting into depreciation, you have to really start getting into or bring on someone like an experienced CPA to help you through the IRS regulations, because each asset has a different depreciation schedule and rules on how long you can depreciate the asset and how long you can carry depreciation on that asset. So in light of that, you know, you definitely have to be familiar. I have someone in your camp that is familiar with, you know, how depreciation works with the IRS, so that way you don't run yourself into an audit, right? But depreciation is a powerful, powerful, powerful tool, because what it allows you to do is lower tax liability without affecting the cash flow position. And that's powerful. How do you think it is that these wealthy people stay wealthy? They figure out what we call efficient tax strategies to be able to lower the amount of money that they have to pay the government. Because the more money that you can keep in your business, the more opportunity you have to be able to deploy that capital into money-making endeavors that are going to grow your business. So I just wanted to come on and shed a little light on depreciation and help you understand. Oh, this other thing, before I forget, check this out. Let's say you have a home-based business, right? Because, you know, you've been watching my lives. You know, you've been following what I've been telling you. You read a book or two, and you decided that you were going to start an online business. Well, when you have an online business, I mean, that online business can be anywhere. And so the cool thing about it is 9 times out of 10, especially when you're first starting, you're going to be at home working. If you have an extra bedroom in your apartment or house or whatever, and that space is where you conduct your business at, did you know that that is a write-off for your business? It's a write-off for your business. So what you would do is calculate the square footage of that space, and you would amortize it against the cost of the rent or mortgage payment. You could subtract the cost of that space based on the overall square footage out of your rent, and whatever that number, or your mortgage, and whatever that number comes up to, you can write off as a business expense. So check this out. You pay your rent every month, you pay your mortgage every month, and you're able to use a portion of that payment to offset your capital gains and your tax liability, right, in your business. Brilliant. Brilliant. You got to pay the rent and the mortgage anyway. Might as well lower some tax, use a portion of it to lower some tax liability. I mean, that's just smart business. That's just smart. So there are a lot of different ways to use depreciation, a lot of things that can be depreciated that most people don't even realize they can depreciate. But anything you buy that's for a business purpose that is a tangible asset has a depreciation to it. No asset that you buy outside of like jewelry, potentially, diamonds, things like that, but that's not a business expense. But most of the things you buy for your business that are tangible assets are, and what do I mean by tangible? That means that they're physical assets, like a phone, like a cell phone, like a vehicle, like, things like that. Those things don't hold value. They depreciate. They depreciate over time. They lose value. And you should always capture that loss in value and use it to offset your tax liability. And I'll say it again one more time. Depreciation offsets tax liability or lowers your tax liability without affecting the business's cash flow position. And that is the best part. That's the best part of depreciation. So anyway, y'all, I hope y'all enjoyed this video. I hope y'all learned something. I hope this video benefits you. If you like what I'm talking about, feel free to like, subscribe, follow, and share this information with anyone that you think can benefit. Because the more people that get eyes on this content, the more people will be able to elevate their position financially and put themselves in a better position to be able to be successful. As always, we hashtag get real woke around here. We hashtag make it make sense. And y'all know when I come on these lives, it's always hashtag for the free. Alright, y'all. I appreciate y'all. Y'all have a blessed and happy Friday. I holla.